now everybody got the announcement that the meeting is being recorded, so officially welcome everyone to our second talk in the series of the information on how to handle your finance in Germany that Women Tech Makers Berlin is doing in collaboration with FinMarie. And today joining us Caroline Bell. Caroline is the Managing Director of the FinMarie, and she will tell a little more about herself and what got her to this place, into this talk, into this field. And I will tell you in a few words about Women Tech Makers that we started in 2015. The Berlin branch is part of the global organization. We're all volunteers, we're all doing this because we really enjoy this. And our main goal is to make the Berlin tech scene more diverse. This means tech talks, this means talks on how to negotiate your salary or write your CV. This means workshops on Android and JavaScript and Go and so on and so forth. And all our events are on Meetup, and we're happy that you joined. And without further ado, please welcome Caroline.
Thanks, Natalie. Well, I've been a financial advisor now for nearly 30 years, which is a scary thought. I've been a financial advisor in Australia, the UK, and Germany as well. I got into money and investing really, really young. So I started buying shares when I was about 12 or 13 years old because my grandfather got me into it. And I used to chart share graphs and all sorts of things. But to me, money was always about having choice, having freedom and having independence. So to me, money is not about sort of dying rich and having €1 million in the bank when you die. Money is about giving you choice and living the lifestyle you want. And that's why it's always been really, really interesting to me. And also seeing the impact that it has on someone's life is the reason why I got into financial advice. I'm Australian. I've lived here for 4.5 years. For those that missed the early chat with Natalie, I came to Berlin. I was looking for a challenge. Didn't know German, didn't know anyone, just decided to move over here. But Berlin is definitely home. And then coincidentally, about 12 months ago, I was introduced to Carolina Decker, my now business partner. And she was looking for someone who really wanted to focus on helping women with financial matters in terms of money and investing. One of the things that I've noticed as well that Carolina has experienced personally is women in Europe don't have as much financial confidence or as much financial independence as women in some other countries, such as Australia, the UK, or the States. So our goal is really about education and helping predominantly women, but we do have male clients as well, just really having more confidence and control. So I'll share my screen and we'll get started. That's not working.
This looks good. We can see your slides.
Yeah, you can see it. Fantastic.
Right now we can see the other screen, but before that we saw these slides.
I've got two screens.
There. This is now in the right. Oh, it jumped away.
Perfect. How's that?
No.
No.
No? Are you kidding? Okay.
Empty screen.
How's that? There we go.
This looks good.
Excellent. Perfect. So what are we going to cover today? So really it's about getting you investment ready. It's about getting you ready so you can actually get started. So the topics that we're going to cover off on is how much should I invest? Why am I investing? Getting the right mix of investments, talking about tax, talking about some other things that come up. We're going through COVID-19 and I'm guessing many people here are expats, and that brings another level of complication. And then really some next steps in terms of what to do to actually start investing. So really, in terms of how much you should invest, this is very, very much a personal question. And look, the easy answer is as much as possible. But there's some things that need to be taken into account. And I'm a great believer in managing cash before you start investing. And by managing cash, it's really making sure that you've got enough money sitting in an emergency account that you don't then need to access if something happens. And what we've all sort of just been going through with COVID-19 and people having to do Kurzarbeit, some people losing their jobs, is a perfect example of why you should actually have an emergency account before you start investing. And so what do I mean by that? So I generally recommend people have a transaction account. And your transaction account, your salary is paid into that, and then any expenses come out of it. But there's really not much of a balance sitting in your transaction account. It's really just to make sure that you can pay your everyday expenses. Then your emergency account is exactly that. It's money sitting there. So, you know, if something breaks down, if you lose your job, if you have to go on Kurzarbeit, then you've got money sitting there so you don't need to access the portfolio. And if we think of what we've just gone through with COVID-19, where some people have actually, you know, using Kurzarbeit as an example, where people have been maybe earning a little bit less, and at the same time markets have sort of gone down a lot, so it's the worst time that you'd actually need to or have to sell down your investment portfolio to have some cash to live on. And so we generally recommend that you have about 6 months worth of expenses in a savings account. So you really have got your transaction account, 6 months worth of savings in a savings account, maybe 3 months if you've got a really secure job. So freelancers, you would definitely have a minimum of 6 months. If you're in a really sort of secure paid employment position, then you could probably get away with only needing 3 months in an emergency account. Once you've got the amount in your emergency account that you're comfortable with, then you can start investing. So the amount that you should be investing is really money that you're putting away for your goals, whatever they might be, and we'll talk about that in a second. But money that you don't need really sort of in the next 6 months. And again, another complication with expats is, well, what happens if there's a family emergency back home and you quickly need to buy a plane ticket and get back? So really sort of expats, I generally find, need a little bit more money sitting in an emergency account as well. So they've got access to that money so they don't need to sell their investments. The worst thing about selling your investments is when markets are down, and then that's when people really do make losses. You really ideally only want to sell your investments when you've achieved that goal or when you're ready to actually use that money for that goal, whatever that goal might be. Now, in terms of working out, well, how much should I be saving? Because with most people, particularly when you're young, your biggest asset is your income. That's your biggest source of wealth, really. So in terms of how much you should be saving from your income, we generally like to use the 50-30-20 budget rule. I don't believe in setting fixed budgets in terms of, I don't believe in saying, okay, I can only spend, you know, X euro on lunch this week. No one likes to feel restricted. And let's face it, during COVID-19, we've all been feeling restricted anyway. So we don't want even more restrictions. But an easy way of managing it is really sort of saying, okay, well, based on my after-tax income, I'm going to allocate 50% to needs. So 50% of my after-tax income is on stuff that I have to pay for. I have to pay for food. I have to pay for my rent. I have to pay the electricity bill, any insurance payments. So allocating 50% to that. Then 30% to wants, and 30% is all the things that are nice to have that makes life a little bit better. So it's going out to restaurants, to the cinema. Now, we've all been saving probably more than 30% given COVID-19, unless people have been doing some crazy online shopping. But, you know, going to the gym, all of these things that really sort of make life nice, try and restrict that to 30%. And then your other 20% is savings. So you might sort of only start with a really small amount in terms of getting to starting investing. But if you can save 20% of your after-tax salary each month, then you're actually going to find that that's going to grow really quickly. And the reason for that is savings plans work. So I know a lot of people feel that they can't start investing yet because they don't have enough money. And it's one of the reasons why at FinMarie we've sort of set up investment strategies where you can start with as little as €100. Because it's not important to start with a big amount, it's important just to start with a savings plan. So that amount can grow really quickly, quite fast when you do have this savings plan. Now, in this example, we've got an initial investment of €1,000 in both cases. Then on the left, we've got a monthly savings plan of €100. And then on the right, we've got €200 per month savings plan. And as you can see from the projection, they're invested in exactly the same way, but there's a big difference after a 10-year period. Just an extra €100 per month has made a difference of, instead of having 18,000 after 10 years, you've got 34,000 after 10 years, which, you know, 10 years can sound like a long time, but also to have sort of an extra 16,000 euro, almost double after a 10-year period, just by having that extra 100 euro per month, really sort of makes a difference. And that's through the benefit of compounding. And by compounding, what we're sort of talking about, because you might have sort of heard about interest compounding or the magic of compounding. So your investment strategy or your investment portfolio earns income. So any investment portfolio gives you a capital return, and by a capital return, we mean that the value of your investment goes up. So you might start with a 100 euro investment, but if markets go up, then it goes to 110 euro. And that 10 euro is a capital gain. But the other form of return you get from your investment portfolio is income. And when you reinvest the income that you get from that portfolio, and instead of spending it, you add it back in and reinvest it into that portfolio, then the next year your capital growth is higher and the income is higher because you have more invested. And so that becomes this snowball effect, which can really improve and increase over time. And even experienced investors completely underestimate this benefit of compounding. So if you feel that, oh, look, I don't have very much to start, as long as you can start adding an amount each month to your portfolio, you can start with really small amounts. It really is worth it. Then, of course, you need to start thinking about, well, why am I investing? And the reason why this is so important is it determines your investment time frame. Now, what do I mean by this? It means that how long is your money going to be invested for? Now, for some people, you could be saving for retirement, which means it could be quite a long investment time frame. And the ideal situation is you just keep investing and you don't really take anything out of your investment portfolio. However, for others, you might be saving up for a deposit on an apartment, or some travel or something else in the next 2, 5, or even 10 years. And so the shorter your investment time frame, then generally more conservative investments that you want to have in that portfolio. But if you're only in your 30s and you're already starting to think about saving for financial independence, then you can be a lot more aggressive with shares. And we'll talk about the different types of investments as well. And so I generally talk about financial independence rather than retirement. I know particularly here in Germany, the concept of retirement is still fairly entrenched. But for people from many other countries, it's not so much about retiring at a particular age, especially because the German system is so tied to the pension system. By being financially independent, you can choose when you want to work. And this is something that really does impact a lot of expats. So it's quite important for people that want to achieve financial independence before the pension retirement age, to have money invested outside the pension system so they can access that money before they can access their pension benefits. But it's really important before starting to actually know why you're investing. What are your goals? What do you want to achieve with your money? And I really recommend that you write them down in terms of what is it that you want to achieve with your money. Not only then as well the amount that you need to achieve that, which is very simple. If you want to buy an apartment and you need a deposit, that's generally pretty easy to work out. A little bit harder if you're talking about financial independence, and you might need a little bit of assistance with that, but also the time frame. So then you've got a specific period of time that you know that you want to achieve in terms of investing a certain amount. And then that helps also works out, well, what's the monthly amount that I need to start saving to help achieve that? And in the previous projections here, one of the tools that we use with our clients is really sort of to say, okay, based on this amount that you're going to start, based on a savings plan of this, we can then sort of say, well, how much will you achieve in a fixed period of time? Or in this period of time, you will achieve this goal. So using projections online can be really useful to help you work out what the amounts are and what the timeframes are. As I said, your age doesn't necessarily mean your investment time frame. It's your goal that's going to determine what sort of period of time you're going to be investing for. So it's really looking at, well, what is the right mix of investments? And we're going to sort of talk about the different types of investments. But the most important thing to sort of really think about is risk and how to manage risk in a portfolio to get what I call the sleep at night factor. There's no point having a really aggressive investment portfolio that's 100% invested in shares if it means that you're waking up at 2 o'clock in the morning worried about what your portfolio is doing. So I recommend that you really understand the different types of investments and work out what is the right mix of investments for you, and then really look at diversifying out some of the risk using different types of investments. So, but before we get into that detail, I want to talk about saving versus investing versus speculating. A lot of people in the media or in the news use these terms interchangeably, but they're actually three very different things. So saving, we all really understand. Saving is when you've just got a bank account and you're depositing money into a bank account. The money sits there. In normal times it would earn interest, but let's face it, no one's earning interest, particularly in Europe at the moment, on savings. But it's incredibly safe because you know that if you put €100 into a bank account, there's still going to be €100 exactly in a month's time, in a year's time, in 2 years' time. Investing is where you start taking a little bit more risk. So investing is when you're starting to invest in either property, in shares or bonds. It's still relatively safe, and there are things that you can do to manage the risk, which we'll talk about, but you expect to get growth from your investments. So you expect it to increase in value over time. And this is the reason why people invest. Keeping money in a bank account is a risk in itself because, especially with inflation, the value of your money decreases. So the purpose of investing is to get this higher growth, but to get the growth, because the value of investments can go up and down, you really need this longer term time frame, especially more percentage or the higher percentage of stocks that you have in the portfolio. And then lastly, and we've seen a little bit of this during COVID-19 because markets have been so crazy, is you have speculative investment or speculating. And this is what is really quite risky, and this is where you are just taking bets. So for example, when people are investing in things like gold, they're speculating. Gold doesn't do anything, it's purely a price movement. So a gold doesn't produce something like a company does. It's not going to give you an income like a stock will. It's really just based on the share price movement in terms of what your return is. And really no one knows where the gold price is going to go up, it's going to go down, because it's based on what's happening in the world and things change so quickly. People also speculate on the stock market. So when a buy and hold strategy is a long-term investment strategy, but buying and selling based on day trading or very short-term movements is considered speculating because you're really basing it on the price alone. So as we talked about, investing means taking risks, and we'll talk about some of those risks now, but not investing also means taking risk. And the main reason or the main risk if not investing is having money sitting in a bank account, not doing anything, not earning any interest. You're losing value in that, and then you're not achieving your goals. So in terms of the options, broadly, any investment or anything that you can invest in will fall into 5 categories. There's a 5th category, which I will talk about, but don't really consider it to be a true investment. And certainly not something I recommend to my clients because it is more speculative. But any investment that you see can really be categorized into one of these 4 categories, no matter how complex the investment might seem. At the end of the day, it's really just a version of one of these 4 categories. Cash, of course, is the simplest to understand. Cash is, as we all know, is money sitting in a bank account, money sitting in a term deposit, or some other type cash-based product. The next type of investment, which is a little bit more complicated, and we'll go into a little bit more detail about each of these, are bonds. And so bonds are loans. So you're not investing in a company, you're actually making a loan to a company or a government, and that government or company pays you interest on that loan. So a bond gives you a higher return than cash because there is a higher level of risk. The value of that bond can go up and down, but it's still not like investing in a stock. Then you've got property, and we all understand property in terms of buying an apartment, which you then rent out. But you can also invest in property that's listed on the stock exchange, where a property manager actually buys lots of properties, rents out those properties, particularly commercial or industrial type properties, and then shareholders can actually buy units in those property funds. And then we have equities or shares, and this is where you're buying units or actual shares listed on the stock exchange. Now, in terms of risk and return, and everyone has probably heard how there's a correlation between risk and return. So when something has less risk, it has lower return. If something has more risk, then the potential is for higher return, and it needs to give a higher return to investors to compensate for that risk. So if we look at the scale here, we've got cash at the bottom, then we've got bonds, then we've got property, and at the top end, with the highest risk and the highest return, we've got stocks. But there are ways to mitigate that. Now, as I mentioned, there is a fifth category, and that fifth category is commodities. And commodities are just objects that you buy and sell. They don't give you an income. Again, gold is a commodity, whereby you're actually just buying gold or a gold ETF or a gold fund, and then you're getting a return based on just a pure price movement. That's sort of considered to be the fifth type, but again, it's a speculative category, so it's something that we don't sort of recommend to clients. So the first one that we'll look at is stocks. So in terms of how a stock works. Now, I apologise to anyone who is quite experienced and sort of knows and understands these concepts, but we've got a really broad mix of members here, so it's good just to sort of go through some of the basics. So in relation to a stock, when you're a stockholder or a shareholder, and it means exactly the same thing, you're buying a share in a particular company that's listed on the stock exchange. Here in Germany, it's the DAX, or it's the main sort of index that you then buy a unit sort of in that index, or a particular company. So any company that's listed on the DAX, you can buy a share in that company. And as a shareholder, then you get the benefits are, if the company does well, produces really good profits and grows, you get the benefit of that because the share price of that company increases. Then, of course, the company pays dividends as well. So this is the income part of the return. So you've got the combination of the growth in the share price as well as the dividend return. The problem is, company may not do very well. So the company may fall in value, or there may be some negative news about the company and the stock price may fall. And then some companies, if they're not doing well, they won't even pay dividends. Now, we will go through periods just like COVID-19, even though a company might be doing well, if there's really sort of a lot of negative news in the world, such as COVID-19, even a good company's share price can fall based on just world events. And this is one of the reasons why we recommend that if you are buying stocks, you're holding it for a longer period of time. Now, in terms of how you can buy stocks directly, just like in the previous slide, or you've got a couple of other ways, and using mutual funds or ETFs is a way of diversifying some of the risk out of buying stocks. So if you're a relatively new investor and you buy a single stock, you're taking a lot of risk because you're putting all of your faith in that particular company, that particular company is going to give you a good return. And maybe it does, maybe it doesn't. The benefit of buying an ETF or a mutual fund is these products buy a whole heap of stocks or other assets, and then you're buying a unit in that particular fund. And then therefore you're getting the benefit of diversification, and you're basically buying a unit of a fund that holds hundreds of stocks in some situations. And generally you find that for example, there's ETFs that follow the DAX. So whatever the DAX is doing, the share market general index, the ETF will follow that market movement. So you're essentially getting the market return without taking the risk of buying a single stock. A mutual fund operates very, very similar. The main difference is you can buy an ETF like a stock on the stock exchange. A mutual fund, it's not listed, so it's only sort of trading once a day, and you generally buy that through a financial advisor or a bank. So you sort of think you've got stocks, you've sort of got mutual funds, and ETFs, they're sort of like a mutual fund in terms of they're a basket of different stocks, but you trade them like a stock. So they're generally the most flexible form of investing, and particularly for new investors as well as experienced investors, they're a really good way of accessing the market and getting a market exposure and not having to worry about which particular or individual stock that I'm going to buy, as well as how do I know which stock to buy. Then we have bonds. Now, bonds are a little bit more complicated. As I mentioned before, A bond is where you're lending money to a government or a company. That loan is fixed for a period of time, and the amount is fixed, and the interest rate is fixed. So the borrower, so effectively the government or the company, has to pay you interest on that period, on that loan over a period of time. Now, where it gets interesting is this interest rate is fixed, but let's say you've got a bond that's paying 2% interest rate. But let's say interest rates increase to 3%. All of a sudden, your bond's not looking very good because you're only getting 2%, but you go to the bank and get 3%. So the value of your bond falls. The flip side of that is if you've got a bond paying 2% and interest rates fall to 1%, your bond's looking pretty attractive. And so the bond price or the bond value increases. So this is how bonds can still go up and down in value, but not nearly as much as shares. And this is why they're considered to be more conservative than shares. So they give a higher return than cash because the interest rate is higher. They can go up and down in value, but not very much. So this is why they're considered to be less risky than stocks. But there are some things to really sort of watch out for, and that's the credit quality of a bond. So if anyone remembers the global financial crisis that happened back sort of 2009, one of the main problems came from bonds that had really bad credit quality that then all sort of failed. So when looking at bonds, it's really important to understand the credit quality. You only want good credit quality from bonds, because if you're going to take extra risk, take that with the shares, not with the bonds. And so a junk bond, I don't know if anyone's sort of heard of a junk bond before, which sometimes you hear on in movies and what have you. That's essentially a bond with no credit rating. So you expect the return to be really, really high, but there's a very high risk of the bond failing or the loan not being able to be paid. And I've had clients over the years that get super excited about some investment they found that's paying an interest rate that's 3 times as much as what they get in the bank account. But when you look behind it, it's essentially a junk bond. And so they're taking a bet that, well, they're hoping that the bond provider will still be there at the end of the bond term. So just as a summary, because this is one of the main points to understand between bonds and shares. So if you're investing in a bond, you're actually lending money to a company. Whereas if you're buying shares, you're actually buying shares in that particular company. So essentially, when you own a bond, you're like a banker. You're lending money to someone. Whereas when you've bought a share, you actually own part of that company, whether it's through an ETF, a mutual fund, or directly. You're a shareholder. And so with bonds, you get your return through interest repayments during the period, and then at the end of that loan, you get your money back. Whereas with shares, you get your dividends along the way, and you hope for an increase in the share price, but you have absolutely no guarantee of getting your money back. And this is where the difference is between bonds and shares, and why bonds are much more secure and considered to be more conservative and safer than shares, but also why it's so important to understand the credit rating of the bonds as well. So how does this all look in a portfolio? So these are the FinMarie portfolios that we use with our clients, and we have 5 different portfolios. And what I want to show here is just how the different mix of shares and bonds works, and what sort of expectations you can sort of have from the different portfolios. Now we'll do a comparison between a Grow 30 and a Grow 70. A Grow 30 is 30% in what we consider to be risky assets, so shares, and a Grow 70 is 70% in shares, so more aggressive. And on the defensive side, it's the opposite. So the Grow 30 has 70% then in bonds and 30% in the Grow 70. Now you can see as well here that we've sort of got a really big mix of shares around the world. So another way of really diversifying out your risk is not investing everything in one country, in one region, or in one industry, but really trying to get broadly diversified. So you've got shares in different countries, in different industries. So you're not sort of subject to what's happening in one particular industry. So for example, if anyone just had shares in Wirecard, for example, or if someone just had shares in Lufthansa, they'd be feeling pretty hurt right about now. And this is the benefit of diversifying, which you can achieve really easily through ETFs. So if we sort of go down to sort of the bottom where we've got expected returns. Now for a Growth 30 portfolio, the expected return is 3.4%. For a Growth 70 portfolio, it's 6.1%. So it's a big difference. And this is a per annum figure. So you would expect a much better return from a Growth 70 because it's got 70% of shares, not 30%. But the expected volatility is also a lot bigger. So by expected volatility, what we're talking about is how much can you expect your portfolio or the value of your investments to vary by. With a Growth 30, we're only talking about 4.9%, but with a Growth 70, we're talking about a 10% variation. So that's another big difference. And this is why it's really important to understand what are you comfortable with? What sleep at night factor can you have? Can you still sleep at night knowing that a portfolio might go down by 10% because you've got a higher percentage in shares? Or are you more comfortable with a slower volatility but a lower return? And this is where your investment time frame and your goal comes into play as well. If you're saving now for financial independence, then you can weather any storm. You've got a long investment time frame. Markets do crash, but they also come back again, especially when you're diversified and not invested in one particular stock. So you can still have a sleep at night factor if you've got a 10% variation in your portfolio over time. If your investment goal is to buy something in only 2 or 3 years, that 10% could be really hard to live with, and maybe a Growth 30 or maybe a Growth 50 is more appropriate, where the return might not be so much, but also the volatility is not as much as well. Especially if you know that you want to use that money that you've invested at a particular time. And again, COVID-19 is a good example. You don't want to have to sell that portfolio just when markets are crashing. Now, in terms of tax, so this is always something really important to think about, because what's important when looking at performance is performance after tax and after fees. So when I'm talking about tax here, really just talking about Germany here, but there's a flat tax of 25% on income and capital gains. So when you're investing, any income and capital gains, so this increased return on your portfolio when you sell, is going to be subject to tax of 25%. But in Germany, you get a tax exemption, or you're allowed to earn €801 for 2020 for singles, or if you lodge a joint tax return, that should be €1,602. You're allowed to earn that tax-free every year. Now, most Germans know this, but a lot of expats get caught out because they don't sort of realise. But wherever you have your investment account, you can actually lodge for this Freistellungsauftrag directly with the investment provider, and they handle the tax. So you don't need to worry about including it in your income tax return. If you earn more than €801 or €1,602 per year, then the investment provider will automatically deduct that 25%, but only on the amount over and above that you've earned over those tax-free amounts. But of course, things get a little bit complicated when you're an expat. So a couple of the things to talk about in terms of expats and investing. And look, I'm sort of one myself. It's not so much about anything that you need to specifically do with investments, other than understand your tax situation in your host and your home country. So it's one thing to know the situation, let's say in Germany, if you're a tax resident in Germany, but you also need to understand, are you still liable for income tax in your home country? And that's going to depend on your home country tax rules. So me personally, I'm not. I can invest here in Germany and I'm not taxed in Australia because of the tax rules in Germany. I'm not considered to be tax resident. But if you're a US citizen, then you are. And there's sort of double taxation agreements. You're not going to pay double tax. You do get tax credits, but it just makes life a little bit more complicated. And of course, the other problem for US citizens in particular is if you don't have dual citizenship with, say, a European country, there's very, very few institutions in Germany that will accept you as an investor because of the IRS reporting requirements that the financial institutions have to do if they have US investors. So for example, we at FinMarie can't accept anyone who only has US citizenship just because of the reporting requirements. So if you're a US citizen only, you really are restricted in terms of investing in Europe. The other thing to note with being an expat is, of course, you're in different pension systems. So, as we all sort of know, the German pension system rewards consistency and can have sort of really good pension payouts when you've been contributing to the system for a long time. But when you've sort of been in other countries and you've sort of got holes in your pension history, that's not going to provide you with a very strong pension income. So we generally find that anyone who is an expat really sort of saving for financial independence or retirement outside of the pension system is going to give you a lot more flexibility. Also, one of the other things, of course, that happens is market crashes, and we've all been living through it with COVID-19. But already, the market's come back from its low, which was in mid-March, and it's already made some really good gains. So we've actually had a few clients that started investing with us in mid-March, and they're already sort of sitting on sort of 15 to 20% capital gains in a short period of time, which is unusual. But also, anyone who's sort of been following the news may have heard about Wirecard recently and how sort of Wirecard's gone into liquidation. And you can sort of see here in terms of what's happened with the share price. And this is one of the problems when investing in single companies as opposed to a mutual fund or a broadly diversified ETF or an index fund, that you can get caught out if you sort of make the wrong decision about which company to invest in. So diversifying into an index portfolio really sort of takes away something like Wirecard happening to your money. So with the sort of the market crashes, and there are a lot of people getting a little bit freaked out, interestingly, based on my experience and having invested or having advised clients through the global financial crisis and now through COVID-19 as well, it's the experienced investors that are completely fine. They're cool, calm and collected because they've been through it before. They know that markets go down, but they also know that they go up again. And in fact, most experienced investors during the worst of a crisis are actually asking, I've got a little bit of money, can I invest it now? Because they know that there's potentially really good return when markets recover. So it's really important to sort of keep a really clear head during these periods of time, particularly if you're diversified. If you're invested in Wirecard, that's a different story. But when you're diversified in an index fund or an index ETF, you can afford just to ignore the noise. Media sells stories and they like to sort of blow everything out of proportion a little bit. Don't let the emotion take over. Focus on your goals and just, as I said, stay diversified. And just really sort of talking to help put COVID-19 into context. COVID-19's never happened before, but the concept of a COVID-19 happening has happened many times over the years. It was just something different. And it happens so often that there's even a term for it. They're called black swan events, which are just really rare and unexpected events that no one can predict. And so as you can sort of see, we've got quite a few black swan events over the last few years. And what we've got here is how much the share market went down. The global financial crisis was, of course, the worst, went down nearly 60%. And it took 1,022 days just to get back to where it was. So that was a really long period of time. But the difference between the global financial crisis and what we're going through with COVID-19 is the global financial crisis was a fundamental issue in the banking system. COVID-19 is a health issue, and which has prevented people from working, traveling, and sort of consuming, but it's not a fundamental financial issue. So I certainly don't expect the recovery from COVID-19 to take nearly as long. And as I said, we've already seen a real increase in the last couple of months. But really the purpose of this slide is to show crises happen. The next time it will happen again, it'll just be something different. But as you can see from this graph, they do recover. And this is where if you can stay the ground, focus on your goals, ignore the noise and stay diversified, you'll do really well. But I will sort of warn, and I see this over and over again in terms of what we call the roller coaster of investor emotion. And if you can overcome, the investor emotion, you're doing better than 90% of investors out there. And it's really just sort of human nature to get excited when things are going really well, and sort of, wanting to buy more. One of my jobs as a financial advisor is to actually calm people down from buying too much when markets are doing really well, because markets are cyclical. So what goes up also comes down. And then when markets are down, no one wants to buy, even though that's the best time to buy. So this is one of the important things with investing, is if you can take the emotion out of it and really try and think logically about where is the point of this, maximum financial opportunity, and where is the biggest risk. When markets are high, that is the biggest risk, not when markets are down. And this is sort of one of my favorite quotes, again, quite relevant just given what we've been going through with COVID-19, especially for anyone that might have had their confidence a little bit knocked around by what's happening with share markets. Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And one of my clients in Australia, against my advice, sold his portfolio right at the worst of when the markets were down in March this year. And of course, he's missed all of the recovery that happened in the last 2 months. I actually fired him as a client because he didn't do what I said. So when you can really sort of hold your ground and not try and time the market, you're going to sort of do really well. And this is the point, you can't time markets. So this is a really messy slide. All it's really trying to show is the different investment returns from different countries around the world, from their highest return to their lowest return, from 1999 through to 2018. And all it's showing is there's no pattern. You can't predict which country is going to be at the top of the table and which is going to be at the bottom every year. And it just means you can't, when you try and time markets, you're going to end up losing rather than winning. No one has the skill and the ability year on year to pick winning stocks, winning countries, or anything when it comes to that. This is why consistency is the way to go. So as we sort of said, getting started. So what happens now? Firstly, ignore the noise, stay diversified, and don't let the emotion take over. But in terms of how do you actually start? So you can start with your bank. So any bank would be more than happy to sort of generally welcome you as an investor. Depending on the bank, they can be a little bit fussy about how much you have to invest. And if you're starting small, they may not welcome you as much with open arms. But generally find, especially in Germany, going to your bank, speaking to a financial advisor or opening up an investment account with your bank is generally the most expensive option. Then, of course, you can go to an online broker, which is like an online share trading platform, and buy something like an ETF or shares directly yourself. You can also use a financial advisor where you go in and see someone face to face. But that also, like the bank, is generally a more expensive option. But at least you do get one-on-one, well, you should get one-on-one and a much more personal service and a hand-holding service. And then there's also a concept now of a robo-advisor. And this is what we are at FinMarie with a hybrid advice solution. So in terms of a robo-advisor, let's try to sort of change the thing there. So a robo-advisor provides a lot of the administration and the diversity and the portfolios. So it's basically a combination of do it yourself using and sort of a financial advisor expertise. And it's something that's developed over the last couple of years. So when using a robo-advisor, and there's quite a variety out there, you just sort of need to watch the fees as well as the minimum investment levels. There are some robo-advisors out there that don't accept anything less than €10,000, which is crazy. But with a robo-advisor, you go online and you answer a series of questions. And those questions determine which portfolio is right for you. So it's basically designed to sort of work out what is your risk appetite, what sort of portfolio are you comfortable with. So as we went through those 5 different portfolios previously, those questions that you answer personally help determine which portfolio is right for you. The benefit of that is you're not having to specifically select not only the investment mix, but also the specific investments as well. That's all done for you. Then, of course, it includes automatic rebalancing. Now, rebalancing is an interesting one in terms of even a lot of professional investors don't do rebalancing properly. But by rebalancing, we sort of talk about getting your portfolio back to the level that you started with. So if we look at, let's say you start with a 50-50 portfolio, 50% in bonds and 50% in shares. Let's say you invest now and expect markets to do quite well as they continue to recover from COVID-19 over the next 12 months. And in 12 months' time, your portfolio is now, because shares have grown, actually 60% of your portfolio is in shares and only 40% is in bonds. But you're a 50-50 portfolio, that's what you're comfortable with. So with rebalancing, the robo-advisor then sells down the profits that you've made and buys back in relation to the bonds to get you back to that 50-50. The opposite can happen as well. So during COVID-19, what would happen with a robo-advisor is because share markets have dropped, so maybe the share portfolio was only 40% of your portfolio and bonds were 60%, the robo-advisor would then sell down some of your bonds and actually buy the shares and get you back to that 50-50. So it's a really good way of actually buying when markets are cheap or selling when profits have been made. The other benefit of using a robo-advisor is it does all the paperwork for you and it gives you online access, including checking performance. So you don't have to worry dealing with all the paperwork that's associated, particularly with individual investments using an online trading platform. And then especially for anyone who has a savings plan and wants to invest a regular amount each month, using a robo-advisor, you just set up what your monthly savings plan is, whatever that amount is that's right for you, and then it automatically allocates that monthly amount across your portfolio. If you're doing it yourself as a DIY investor and you're adding it in, then you're incurring those brokerage costs, but also you need to allocate your €100 or whatever it is across whichever investments that you selected. So it's much more of a manual process. And then the robo-advisor as well gives you a tax statement at the end of the year as well. So in terms of implementing the portfolio, we've talked about rebalancing. Dollar cost averaging is something that will automatically happen if you have a savings plan. And the benefit of dollar cost averaging is when markets go down, and particularly given everyone here is really building wealth. So you're all buyers of share markets. You're going to be adding to your portfolios. So interestingly enough, even though it might sound a bit weird, you actually want markets to go down, because when you buy each month, you're then buying more shares or more units at a lower cost. So let's say, for example, you've got €100 each month as a monthly savings plan. When the share price is lower, you get more shares for that same €100. When the share price goes up, you get less units for that same €100. And this is what dollar cost averaging does. It basically just averages out your price in terms of over a period of time. So you're not buying too high or too low. But again, that happens automatically if you have a savings plan anyway. Expenses, turnover and taxes. And this is where ETFs are really quite useful. Particularly with managed funds, there's active managed funds and there's passive managed funds. If you hear the words active and passive used, essentially passive is like an index. So either an index fund or an index ETF is just following the DAX or the MSCI World Index. So whatever the market's doing. And those fees are very then low cost. If you've got an active fund, which is generally used by financial advisors and banks, the fees are much higher. Now, I personally don't believe that anyone has the skill or the ability to consistently pick winning stocks, and especially in low return environments. And as we know, after fee returns are important. You want to minimize your fees as much as possible. So whatever investment option that you're looking at, always make sure you've got a really good understanding of what the fees are that you're paying with investing. And then, of course, turnover. By turnover, we mean how often within the fund, or how often are you directly or within the ETF buying and selling or turning over stocks. And the more you turn over stocks, the more likely you're paying taxes, which reduces the after-tax return. Staying disciplined, we've talked about understanding fees, and then also just making sure when you're looking at an investment option, can I have a savings plan? There are actually robo-advisors and other sort of options out there where you actually can't have a savings plan. So especially if you're thinking of, I'm ready to start, I've got a small amount, but I want my savings plan each month, just make sure that you can actually do that. So to start finishing off, what do you need to do now? So really just say, okay, am I mentally ready to start? I generally find, particularly for new investors, actually it's one thing to do all the research, it's one thing to look up websites and everything, read the books, but actually taking that first step and actually doing something is often the hardest thing. Really sort of know why you're investing, what are you hoping to achieve from investing, be really, really clear. Know that investment mix in terms of what am I going to be comfortable with and what am I going to be able to sleep at night with. How much do I have to invest? Making sure that you've got money sitting in your emergency account, so if something happens, you don't have to touch your investment portfolio. Am I investing everything that I've got, or do I want to do dollar cost averaging, particularly if you're a little bit unsure and you're new? And how much can you add to your portfolio? So what's your regular savings plan that you can add and how often? And then basically go ahead and do it. In terms of this, one thing that I would recommend, particularly if anyone's interested in sort of building their knowledge, we at FinMarie run a FinMarie Facebook group. I post in that Facebook, you don't have to be a client to be a member. I post in that Facebook group 3 times a week, generally Mondays, Wednesdays and Fridays, really just with ideas and information about money and investing. So anyone's welcome to join that Facebook group. Always welcome to join me on, connect with me on LinkedIn. I post things about investing, sometimes videos on there as well. And of course, always happy to have a chat if anyone wants to talk about becoming a client. We also offer 15-minute espresso schnuppens, which basically if anyone's just sort of got some general questions about investing, happy to just get on Zoom for 15 minutes and have a bit of a chat. And then that leaves us with question time.
Thank you very much on behalf of everyone here. There are quite a few questions in the chat. Would it be comfortable for you if I read this out, or would you prefer to read them out for yourself?
No, I happy for you to, yeah.
Super. All right. First question is, scrolling all the way up. So when one pays the income tax and when the capital gain tax, could you please give examples?
Yeah. So the income tax is paid every year. So every year you receive dividends or interest from your investments. And so because that's received on an annual basis, although it may be paid quarterly or half yearly, it goes in your annual income tax return. And it's this amount that then the 801 or the 1,602 euro tax exemption applies. But yeah, it's an annual tax liability, but it's only 25% on the income tax if you earn more than that 801 or the 1,602. However, capital gains tax only applies when you sell the investment. So if you hold the investment for 10 years and then sell it, you only pay that capital gains tax in that year, at the end of 10 years when you sell that investment. The ideal situation for anyone starting to think about saving for financial independence is that you actually don't sell your investment portfolio at all. And when you're ready to be financially independent, you just start living off the income, and instead of reinvesting the income, you actually start taking that income to replace your salary. That's the ideal situation. But of course, other people have goals, which means selling an investment portfolio at some point.
So just to clarify, if you made some profit because some stock you had went up, until you sell it, you don't pay on it.
Exactly right. Only the income along the way.
Income along the way. Yeah, sorry, my swallows did funny sounds. What do you think about borrowing money in order to make an investment in a company that you believe is going to do good?
Yeah, this is an interesting one. There's definitely benefit in doing so. And I have recommended this to clients previously, but it's best in periods of time where returns are going to be relatively high, or there has been a crash. So with what we've been going through now, this could potentially be a good time to borrow money to make an investment. I wouldn't just invest in one company though, because you're already taking on a fair amount of risk to borrow to invest. Because if that company fails, let's say you borrowed and invested in Wirecard, then you still have to pay this loan, but the company doesn't exist anymore. You've completely lost your money. So I would definitely recommend that if you were going to borrow to invest, you generally only borrow to invest in a mutual fund or an ETF or something diversified, so you're taking away this single stock risk. I would never ever invest or borrow to invest in a single stock or a single company.
How does a robo-advisor deal with black swan events?
This is the beauty of a robo-advisor. It takes away the emotion of black swan events. So a black swan event really is an emotional response in terms of when people sell. So with the robo-advisor, because there is no emotion attached to it, a robo-advisor doesn't get scared, it doesn't get panicked, so it doesn't sell the investments. All the robo-advisor does, which is what really works, is if there is a drop in the markets and so shares become cheap, the robo-advisor, through the automatic rebalancing, will rectify that portfolio difference and sell at a percentage of bonds and buy a percentage of shares to take advantage of that drop based on the portfolio that is right for you in terms of, whether it's a 50-50 portfolio or a 70-30 portfolio, to keep you at that portfolio mix that you initially chose. So this is why it's really important to make sure that when you start investing, you've got the right investment mix from the outset. But really, this is one of the benefits, and there's been lots of studies done about robo-advisors and how they've dealt through COVID-19, and the performance or the return from investors using a robo-advisor has actually exceeded those from those doing it themselves, because people individually react with emotion, whereas a robo-advisor doesn't.
You mentioned there are restrictions on investments for US citizens living in the EU. Could you comment on the investment task situation for people with dual US-EU citizenship residing in the EU?
If you've got EU citizenship as well as US, then it's much easier because you can rely on your EU citizenship. There's still going to be tax reporting requirements for you personally, but at least with the EU citizenship, you can access investments here in Europe using that citizenship.
Would you recommend brokers for ETFs that have a good reputation and low close ratio?
FinMarie. So we offer, through our portfolio, we offer ETF portfolios. And one of the things that we're sort of very proud of is they are sort of one of the low cost in the market. Particularly for me, coming from Australia, it's been really quite interesting. What people don't realise is Australia actually leads the world in financial advice. Australians have had to save for their own retirement for generations. So there has been no government pension or employment pension for Australians. They've had to save for themselves, which has led to a much higher demand, much more complex financial advice. The rest of the world is definitely catching up. But that also means, because Australia is far ahead, there's been more competition for investment solutions. And so fees are much lower in Australia compared to Germany. So one of the things that Carolina and I had to do was sort of go out and sort of look for ETFs that have a low cost ratio that aren't expensive, which isn't necessarily easy to do. And personally, my own money is invested with the FinMarie portfolios, which, given I'm sort of comfortable investing my own personal money, that's why I can recommend to clients as well.
Would you, the next one. What does it mean to have a savings plan in relation to investing?
So that essentially means it's like having a direct debit into an investment account. So just like you can have a direct debit or a savings plan going into a bank account, let's say you've got a transaction account and a savings account, and maybe each month you've got a direct debit going into your savings account from what you earn each month. You can do exactly the same thing with an investment account. So each month, automatically, you just have a certain amount depending on what your situation is, where it's automatically added to your investment account. And that's sort of what I mean by a savings plan when it comes to investing. So generally what I recommend with clients, they have their transaction account, they have their emergency account, and knowing you need to figure out, well, what's the emergency amount that's suitable for me. Have a direct debit going into your emergency account until you get to your balance, And then once you've got to your balance that you're comfortable with in your emergency account, then you just swap that direct debit to go into your investment account when you set up your investment account.
What about cryptocurrency?
Yeah, cryptocurrency is an interesting one. It comes up every time. I put cryptocurrency in the same realm as it's a commodity. You're basically going on price movement. And if anyone sort of looked at what the price of Bitcoin has been doing, for example, it's speculation. So if you want to play and sort of just have, that's what I call it. I call it playing with things such as gold or cryptocurrency. You're just taking bets on price movements. I personally don't invest. I've had a couple of clients that played with cryptocurrency, hot tips from a mate, and they've always lost money. But, they've learnt something, and in these situations, they've only played with money that they could afford to lose.
Will these slides be made available later?
Yep, happy to share.
All right. Aren't the social media posts all in German? I'm guessing this is in reference to the Facebook group.
Yeah, so a lot of our social media posts on Instagram, etc., are in German. After all, we do live in Germany. But when I post in the Facebook community, given I look after all of our expat clients, I post in German and in English in the Facebook group. So the hints and tips that are on Mondays, Wednesdays, Fridays are in German and in English. Given I have to think in English anyway, so then it's me translating to German. So it's as easy to put the English in anyway.
You said that keeping one's money in the bank is a risk in itself. Is there a way to secure the emergency fund since it cannot be invested and must be kept accessible? Yeah,
so look, you with the emergency fund, you're really not investing it for interest, just because interest doesn't really exist at the moment here, as we all know. So by having the money in the bank, it's protected anyway. So it's secure in the bank, no matter what sort of investment account you have. Sorry, what sort of savings account you have. What I would recommend though, and it's a good point about being accessible, I wouldn't put it into a term deposit or anything like that. And again, the term deposit interest rates aren't worth it anyway, where you're locking your money up for a fixed period of time. I would just be putting it into an account that you just know that you're not accessing every day for your everyday expenses.
So like a Tagesgeldkonto.
Exactly.
No.
Yeah. Or even something like, I use N26 personally, and N26 is really good with spaces. So you could still have the one account, but you just sort of put money across into a separate category within the one account. Even something like that would work, as long as you're disciplined enough not just to sneak money back from that account. So that will just depend on how disciplined you are. Some people really want to put money, their emergency fund money, in an account where they really know that they won't touch it. Others are quite comfortable using N26 spaces where they can sort of see it, they could access it if they wanted to, but they know it's kept separate.
When working with a robo-trader, are there any pros or cons with regards to ETF versus mutual funds?
Yeah, ETFs are sort of where things are going in the future. So mutual funds have been around for a long time. And when I first started advising, I would use mutual funds, but the ETF costs are lower. So if you're looking at investing, ETFs without doubt will be lower than a mutual fund. There's really sort of no cons with an ETF, particularly when, even the only thing that I would say is if you wanted to buy ETFs directly, so if you wanted to buy ETFs using your own online share trading account and you wanted to have a monthly savings plan, it's going to be easier to have a mutual fund that allows a savings plan, because you can have your €100 per month just deposited into the mutual fund, and then it'll be automatically added to the portfolio. If you've bought individual ETFs in your own online trading account, it's much harder to have a savings plan, because then you have to add that €100 to each of your funds, or maybe €100 to that ETF one month, and the next month it's a different ETF. So it's really hard to have a savings plan or a regular investment plan with your own portfolio of ETFs in your own online share trading account. So if you really wanted to do it DIY and have a savings plan, mutual funds would be the best way to go.
How likely is it to live off investments? Sounds like a 1 in a million chance.
Definitely not. I come from a country where a lot of people, that's how everyone lives. Europe's a little bit different, but particularly anyone in their 30s, it's going to become more and more common. It really just comes down to saving, and this compound effect of saving even just small amounts earlier, when you've got the income being reinvested and added to that portfolio, that investment portfolio really will grow quite quickly. So you're much better off starting when you're 30 with a very small amount compared to when you're 40 or 45 with a larger amount. But it definitely is possible. As I said, I come from a country where people have no choice but to live off their investments. In Australia, if you receive a government pension, it means you're so poor you can't afford to live.
How does the annual tax exemption, for example, the 801 euros, work for when you're not actually withdrawing any money from your portfolio annually? If, for instance, there's an example, but after 5 years, you withdraw after 5 years, you're exempt of 801 times 5, which is 4,005 euros.
Yeah, so this is a really good question because people get a little bit confused between taking the money and reinvesting it. So regardless of what you do with the money, it's your choice whether you reinvest it or you take it as cash and spend it, but you've still earned that money. So from the tax officer's point of view, or from the Finanzamt's point of view, you've earned that income. It's then a separate decision as to what you do with that income. So even if you invest that income, then that amount that you've received that you've chosen to reinvest still qualifies or still gets counted in that 801 threshold. So if you're earning less than 801 euro from your income and you reinvest it, there's no problem. It's all tax-free anyway. If it's starting to grow and build and you're starting to earn more than 801 each year from your investment that you're then starting to reinvest, depending on your cash flow, you might just want to keep a small percentage of that income aside and take it out just to pay the extra tax on that income that you're earning. Hopefully that's a little bit clearer. It's definitely when you receive the income in that tax year, it's definitely taxable in that year. It's then your personal choice what you do with that income, but I always recommend that you reinvest it unless you just really need the money to pay the tax. But having that 801 tax-free threshold each year means you've got easily 801 euro that you can reinvest back into the portfolio without worrying about tax at all.
What resources would you recommend to read and watch in order to get more financial education to be able to build a portfolio smartly?
Yeah, it's a really good question because there's so much conflicting information out there. It's one of the reasons I generally find a lot of people find it hard to get started, because there's just so much different information, active versus passive, stocks or direct stocks versus ETFs, commodities versus stocks. So this is one of the reasons why, again, more than happy, even for non-clients, if you wanted to become part of the FinMarie community, as I said, we post information about all aspects of money and investing and open to questions, because to be honest, if I get questions from our members, I don't have to keep thinking of topics, so it makes my job a lot easier as well. So more than happy to always answer questions. Other than that, there is a good website about ETFs. Let me just see if I can put it in the... If you are interested in ETFs, another good website is there, justetf.com. But it's really hard to get really good information about cash flow, money mindset, goals, sustainable investments. This is why in the FinMarie Facebook, we don't just talk about ETFs, but we talk about all aspects of cash flow and money management.
Which balance of portfolio is recommended for beginners?
This is a really hard one because everyone's different. It depends on what your goals are. It depends on how long you're going to be invested for, and depends on how nervous you are as an investor. So generally, this is one of the reasons why we like the robo-advisor concept, because it will actually take you through a series of questions that is designed especially for beginners to help you work out which portfolio is right for you. But unfortunately with investing, there's no one size fits all. I would generally go something conservative, but not too conservative. So I've never recommended, for example, the Growth 30, which with only 30% shares. I've never recommended that to anyone. As a minimum, I would generally start with 50% in shares and 50% in bonds. But the longer that you can invest, then the more risk you can take. And especially now, given markets are still a little bit down because of COVID-19, there are some potentially good returns if people start investing now over the next 12 to 24 months.
How much would a private person normally pay for a financial advisor and for a robo-advisor?
This question is a little bit like how long is a piece of string? I'll start with the financial advisor first. It can go up to the thousands per year. It just depends on what you need and what the financial advisor would do for you. I'll speak for FinMarie point of view. For financial advice, we charge €300 plus tax, and the tax is about to go down from tomorrow. So it was €357 before the Mehrwertsteuer reduced. So €357 for financial advice. That includes going through your goals, working out some timeframes, working through what portfolio is right for you, and answering any specific questions to your personal situation that you have. In a groups like this, of course, I can't answer personal questions, which is why if anyone has a sort of a personal issue, we can go through that with the personal advice. And the FinMarie robo-advisor depends on how much you have to invest. So if the minimum's 100, which I think is another question in there somewhere, so between €100 and up to €10,000, it's 0.99%. From €10,000 to up to €50,000, it's 0.69%. And if anyone's got over €50,000, it just drops to 0.39%.
How would you determine when is a good time to cash out of an investment ETFs?
When you've got enough to achieve your goal. So really the only time that I would recommend cashing out of the ETFs, because I don't believe in timing markets. People say that they do it, but seriously, over nearly 30 years of giving financial advice, it rarely happens. People don't know when the market's going to crash. Even professionals don't know when the market's going to crash. So the best time to cash out of an investment is when you've achieved what you've invested for. And this is why we sort of talked about be really conscious of what your goals are, really understand why you're investing. And then when you've achieved that, you know that that's then time, well, I need my money now to achieve my goal, whichever goal that is. Me personally, I'm a bit older than everyone here, but I am in this situation where I'm just adding to my investment portfolio with no plan to sell, on the basis that this is what I'm hopefully eventually going to use as my future income stream.
How can I find a reliable financial advisor in Berlin?
Again, I'm slightly biased here, but having been a financial advisor for over 28 years in 3 countries, and just given my testimonials, and I've got a couple of websites in Australia as well, so more than happy to provide testimonials from existing clients. But yeah, I can't go past myself.
Do you have clients that have reached financial independence? How long would it take and what does it depend on?
Yeah, really good one. I do have clients that have reached financial independence, and seriously, as a financial advisor, that's one of the highs when a client does actually reach that goal. It takes a long time. There's no question. This is something that you, over your working life, you achieve financial independence. How early you achieve financial independence depends on 2 things. It really depends on your savings rate. You know, are you saving €50 a month or are you saving €200 a month? That makes a massive difference. And it also depends on what your cost of living is. If you can live on, $20,000 a year instead of $100,000 a year in terms of what you need to live on, that makes a massive difference as well. So I generally find the people that achieve financial independence with more certainty are those that are very good savers, and those that have a good lifestyle but don't, have an over extravagant lifestyle. I've got clients that earn really good money, but they spend their money on everything, and they may never achieve financial independence. So it really depends on being sensible with your money. And one of the things that I would suggest is being really conscious about what you're spending your money on, and really focused on, am I getting value from this? So for me, my personal thing is travel. I love travel. I will happily spend money on travel, but for me, going out to a restaurant isn't so special. So I don't really go out to restaurants very much, and I eat at home more often. But that's my personal value system in terms of what I really get value from with my money. And of course, everyone's different. Of course, I know people who are exactly the opposite. They love, going out to fine restaurants, but they're not fussed about travel, so they don't spend much money on travel. So it's just being really conscious about what's important to you, what do you really get joy from, and then being very conscious about not spending money on something that doesn't bring you joy.
Is there any preferable bank that you could recommend for savings and investments?
Yeah, this is an interesting one, particularly given I like everything online. And as many of us know, so many things aren't online in Germany. Personally, I use N26. The other one is, and there was one bank that was an ethical bank. The name of it escapes me at the moment. But because I've got an Australian passport, my passport wasn't accepted for their online identification system, so I couldn't join them as a customer. I find N26 good. It's all online. Being Australian isn't an issue. Super easy to set up a bank account. And again, I really like the concept they have with spaces, where you've got your one bank account, but you can categorize your money and sort of keep it separate within the one account easily on the app. So that's just my personal thoughts.
Just to clarify, you confirmed you recommend that one for savings and for investments?
Just for savings. For investments, that would be a FinMarie account.
Right. How much money is required to start investing?
So we've got two investment options at FinMarie. One is our standard ETF portfolio, and that we wanted to make really accessible, low cost. You only need to start with €100. It's really, really simple. We do have a sustainable investment option, but that's an active portfolio because it is sustainable. So there's a lot more management that has to be done, making sure that the fund managers are doing what they say in terms of impact investing. And that is €3,500 normally. Although, to be honest, from tomorrow for a week, they've got a special where they're accepting investors with only €1,000 in the sustainable investment option. But normally it's 3.5.
When you say the portfolio grows quickly, what does that mean in terms of growth per year?
Yeah, this is an interesting one because, of course, growth per year changes every year. So it's a combination of the growth, but also with the compounding, what makes it grow even more quickly is the reinvestment of the income. So you're increasing the investment base every year. You're increasing the amount that you've got invested through the income that you're reinvesting. But for a 70 portfolio, so 70% shares, 30% bonds, we're sort of looking at about 6.1% per annum. I expect this year will be higher just because of COVID-19. We're coming off a low base. But on an average, 70% would be sort of looking at a 6% return.
So this is a question about a specific company that is based in Cyprus. And would you consider them reliable and recommend them? So feel free to skip. Their name is, okay.
Yeah.
Does the robo-advisor keep track of what you owe the country? So I guess tax. Maybe the person who asked this would like to clarify if it's not clear.
Yeah, not clear. Julia, feel free to unmute and I'm not sure if you mean tax, like Natalie said, or if there was something else that you meant.
If you want, you can type this also later and we'll get back to this question. Okay.
Yeah, sure.
I meant tax.
Okay.
So you said that obviously if you get your funds out and want to reinvest, you still owe money to the country. So I was wondering if there's any way to keep track of that, or if you're surprised so to say, by what you owe in the end. I don't know if that makes sense. It's okay if it doesn't make sense.
Yeah, sorry, Julie. This is from my, other than the tax liability, which the robo-advisor or the investment institution deducts. Well, it's your choice. You don't have to give them your details. Then you have to do it personally. But other than deducting any tax, if you choose that you want them to do it, there's nothing else that is owed, so to speak.
Thank you.
I feel like financial advisors like to prey on the uneducated and take fees, like you said. Is there some red flags you could share with us?
We've just got one from Tank, just one before that. What can late starters do to catch up?
You're right. Thank you.
Yeah, no worries. In terms of late starters, and I've dealt with many late starters over the years, it goes back to late starters to really try and catch up, just need to save more. And even if that means just sort of cutting down on some expenses. So in fact, someone who falls into this category, who's one of my clients, she is one of my clients in Australia. She had a fantastic life right through into her early 40s, travelled, expensive clothes, the whole thing. But she needed to do some serious catching up. So we were just really disciplined with her savings in terms of, as I mentioned before, just being really conscious about buying, she couldn't buy a new handbag just because she wanted a new handbag. She really thought, okay, is this really, really what I want, or would I rather spend my money on something else? Or, do I really want to focus on my financial independence? So really sort of set her a target in terms of what she should be aiming for to achieve financial independence, and just being really disciplined. But essentially late starters just mean you have to save more, even if it means giving up a few things that you would have otherwise spent earlier. So going back to the one you read out, I feel like financial advisors like to prey on the uneducated and take fees, like you said. Yeah, I have to admit, Julia, it's one of my I've been giving financial advice for 30 years, and it's one thing that really, really annoys me. It is getting better. It's not as bad as what it used to be, but there's still a lot of financial advisors that just really frustrate me out there. So if you do speak to a financial advisor, generally, to be honest, avoid the banks. The banks are there to sell products. That's their KPI. It's what they're assessed on. It's like, if you go to, if you're buying a car, you've got to go to a car dealer. They're going to sell you a car. It's like you go to Sparkasse, they're going to sell you a Sparkasse product. So you really want to try and sort of go with someone that's independent, that's not tied to a large financial institution, and really ask questions about the fees and make sure it's all written down, but also get a sense from them in terms of what questions are they asking you. They should really be focused on your goals, what's important to you, what you're comfortable with. Your first meeting with a financial advisor should be about you. It shouldn't be, if the financial advisor just starts talking about themselves, get up and leave the room, because they're not going to be focused on you. And at the end of the day, this is your money, it's your life, and it's got to be all about you.
Is there a good product for kids to invest in Germany without having disadvantages in the future, like not receiving BAföG or something like that?
This is something that we're working on at FinMarie. I'm not a mother personally, but my business partner Carolina is, and so it's a topic that she's really passionate about. And in fact, she's working with another female advisor in terms of a school education program about money. But we're going to be doing some posts soon in the FinMarie community Facebook group about investing for kids, etc. So if this is a topic that you're interested in, I would definitely suggest joining the Facebook community.
It's also worth mentioning, last month we hosted Carolina for a talk on investing for kids. So it's also on the YouTube channel. You can also look at that.
Yeah.
How can I inform myself about lucrative bonds? For example, how can I invest in companies I know have a potential in tech from my own personal knowledge of the local market?
Yeah, that's something that you'll just have to do sort of really your own research. I don't believe in investing in specific companies. I just think the risk is too high. And I've seen over the years, and it's one of the classic 6 investor mistakes that people make. If they're successful in one part or they have knowledge in an area, they think that applies to investing as well, which doesn't always work out. So I can't answer that, only because it's not an area that I would recommend or suggest that you sort of look at. I would consider that to be a speculative thing, and then based on your own knowledge, use that knowledge to then decide which investment you sort of recommend.
I have 25,000 euros that are lying in my bank account in the last 2 years. I have no goal though. How could you imagine a first step?
So this is actually more common than what you think, and it's one of the reasons why we offer the financial advice as well. Some people actually come to us to actually help work out what their goals are, even if it is just working through financial independence, and then we generally work through when do they want to achieve financial independence, how much do they need to save for financial independence, and help them come up with a plan for financial independence. So, because I completely agree, it's hard to start investing when you don't know what you're investing for. So that's why we sort of offer the one-on-one coaching. Again, just it's generally a 60 to 90 minute session. We ask you to do some homework first. We then prepare the strategy, and then we sort of have a session online to then sort of really sort of so you can walk away with a defined strategy, so you know what your goals are. And this is what I sort of was referring to in relation to the previous comment about financial advisors. It's about you. So part of the value that a good financial advisor should bring is really helping you work out what do you want to use your money for, and giving you a clear plan to achieve that.
Can you tell us more about the sustainable portfolio that you just mentioned? What is the benefit of that one in comparison to another one?
Where's that?
I scrolled to the next question.
Cool. Yeah. So they're two very different portfolios. So the ETF portfolio is low cost, low minimum investment, broad-based ETF. So you're buying the index. So whatever the index is doing for each of those different countries that we went through, that's the return, and that's how it's going to be invested. The sustainable portfolio is quite different in terms of it's an impact investing portfolio, and I could do a whole presentation about sustainable investing options. But this portfolio is specifically designed to only invest in companies that are having a positive impact on social, economic, or regulative areas. And so that's why it's a higher minimum fee. Sorry, it's a higher minimum investment, and the fees are higher as well because there's much more work involved. But it's particularly interesting for those investors who really want to know that their money is doing something good, rather than just generally investing.
I think this concludes all the questions, and there were some comments that the ethical bank name is the GLS, and that what you said sounds like FinMarie that only invests in things that then spark joy.
I didn't say, first of all, I didn't say only invest in things that bring you joy. I said only buy things that bring you joy. So if going out to dinner doesn't bring you joy, don't waste your money. Spend your money on something that brings you joy. Spending and investing, two very different things. To answer Julia, yes, Julia, €100 per month for our Brownie ETF option. €100 to start is all you need as the initial investment, and the per month minimum is €50 as a savings plan.
Any more questions? You're welcome to type or to unmute yourself and then to ask. Going once. Going twice. Yeah, I see a question. And you mentioned about cashing out topic, but for stock, it seems you can make more if you can cash out and reinvest. I don't recommend, or if you don't recommend stock at all.
I think so. There's a little bit of confusion here. So we recommend buying stocks through an ETF. So you're still invested in stocks, just not direct stocks because of the diversification benefits. And some people get confused thinking that you can actually make more if you sell and then reinvest, but you're actually just incurring fees and potentially tax. So unless you need the money to achieve your goal specifically, I rarely recommend that someone cashes out. It's really if someone just needs the money for an emergency and they've used up all their emergency funds, or they've achieved their goal, that we recommend cashing out, just because, again, the costs and the tax.
You also consult for men at FinMarie.
We do. We do have male clients. We just have a higher proportion of female clients.
That's pretty much your entire goal. Thank you so much for the session. Super informative. Yeah. Well, now it's the part where you get to enjoy all the compliments. And,
thanks, Alyssa.
Would you recommend between buying a flat in Berlin with a bank loan or investing?
Lena could do a whole presentation about property purchases. It's quite a complicated topic, especially here in Berlin. And it really depends as well as, are you buying a flat as an investment or are you buying a flat to live in? So I wouldn't be able to answer that with any...
And we have a talk on the 27th with, October 27th with Carolina on the topic of real estate. So Lena, you're welcome to join then as well. We'll cover this topic with a deep dive. Yes, and thank you again very much, Caroline.
Pleasure.
I'm sure everybody learned a lot and gained a lot of information. The recording will be on YouTube. The slides, maybe you can share a link on the meetup page and then this will be just directly connected. The YouTube channel is also available on the meetup page where you all sign up for this event. So any event on meetup.com of Women Tech Makers is always linked to all our social media, including YouTube, and this is where these talks live. So you can always look again and see whatever you want clarification and so on. Fantastic. Yeah, and thanks everybody for attending. Our next event with FinMarie is on July 20th on the topic of Altersversorgung, so pension and so on, all the fun stuff on the other side.
Excellent.
Thanks again, Caroline.
Thanks, Natalie. Bye, everyone.
Bye.